$74 billion. That is not a miscalculation. That is the exact amount of shareholder wealth that vaporized into the atmosphere over a matter of weeks. In a 50-story glass tower in Houston, Texas, 20,000 careers were instantly voided. $2 billion in employee retirement funds were erased. A corporation that commanded $100 billion in claimed annual revenue simply ceased to exist, leaving behind nothing but shredded documents and a staggering crater in the global economy. This was not a hostile takeover. It was not a victim of a sudden macroeconomic shift. It was a digital mirage, carefully constructed and aggressively defended by the very institutions designed to protect the public. How does the seventh largest corporation in the United States operate as a complete fiscal illusion for over a decade, right under the noses of Wall Street's most elite analysts? Today, we open the books on the ultimate corporate disintegration. Today, we perform the autopsy on Enron. To understand the pathology of this collapse, we must first establish the sheer magnitude of the entity before the infection took hold. Enron began its life in 1985 as a traditional, tangible business. Formed by the merger of Houston Natural Gas and Internorth, its primary function was moving natural gas through steel pipelines across North America. It was a utility company, predictable, regulated, and inherently slow-growing. But predictable growth does not satisfy Wall Street. The transformation began when the executive board embraced a radical new philosophy. Enron should no longer be a company that merely delivers energy, it should be a company that trades it. They transitioned from managing physical assets to managing financial instruments. They created complex trading markets where none previously existed. Soon, Enron was not just trading natural gas and electricity. They were trading derivatives on weather patterns, water futures, and broadband internet capacity. The financial markets were mesmerized by this evolution. Enron was transforming the slow-moving utility sector into a high-speed technological trading floor. From 1996 to 2001, Fortune magazine named Enron America's most innovative company for 6 consecutive years. Wall Street analysts effectively crowned the executive team as infallible visionaries. By August of the year 2000, the stock reached an all-time peak of $90.75 per share. Enron's corporate headquarters became a monument to infinite capital. But beneath the pristine glass facade, a deeply toxic operational culture was taking root. The internal philosophy was referred to as the Performance Review Committee, internally nicknamed Rank and Yank. Every 12 months, the entire workforce was graded on a rigid bell curve. The top tier received multi-million-dollar bonuses. The bottom 15% were immediately terminated. This environment did not foster innovation, it fostered desperation. Collaboration was eliminated, skepticism was penalized. The only metric that mattered to survival was booking the next massive deal to feed the relentless demand for revenue growth. It was a culture where failure meant professional exile. And in a system where failure is structurally forbidden, reality itself becomes highly negotiable. The necrosis within Enron was not a sudden trauma. It was a chronic, systematic manipulation engineered through 2 highly sophisticated accounting mechanisms. One mechanism generated phantom profits. The other concealed massive, suffocating debt. Let us examine the first mechanism, mark-to-market accounting. Under standard conservative accounting principles, a company records revenue only when the cash is actually collected. If you sign a 10-year contract, you recognize the revenue year by year as the service is provided and the invoices are paid. Mark-to-market accounting alters the fundamental nature of time. It allows a corporation to estimate the total future value of a long-term contract and record all of those projected profits on the ledger the very day the ink dries. Let us break this down into a clinical, real-world analogy. Imagine you purchase an empty plot of land. You draw up a blueprint for a massive luxury apartment complex. You calculate that 10 years from now, this complex will generate $100 million in rental income. Under mark-to-market accounting, you do not wait to build the apartments. You do not wait for the tenants. You simply take the blueprint to the bank and declare that you have made $100 million today. Now, what happens if construction costs double? What happens if the local housing market crashes before you lay the foundation? The rules state you must adjust your ledger downward and report a massive loss. But in Enron's ruthless rank-and-yank culture, reporting a loss meant losing your career. Therefore, executives were highly incentivized to fabricate wildly optimistic economic projections to book immediate, massive profits on day one. A prime example was Enron's partnership with Blockbuster Video in 2000 to deliver movies over broadband networks. It was a logistical nightmare that was technologically impossible at the time. Yet, upon signing the initial agreement, Enron used mark-to-market accounting to immediately record $110 million in estimated future profits. The project collapsed months later without delivering a single movie. The phantom profits, however, remained permanently on Enron's books. The company was claiming billions in revenue, but because these were projections, no actual cash was entering the building. Enron was suffocating from a severe liquidity crunch. To keep the lights on, they had to borrow astronomical sums of money. If Wall Street analysts saw this mounting debt, the stock price would plummet, triggering a catastrophic downgrade. The debt had to be hidden. This brings us to the second fatal mechanism, special purpose entities, or SPEs. An SPE is a perfectly legal financial instrument when used correctly. It is a separate limited liability company created to fulfill a specific narrow objective. But deep within the finance department, these entities were weaponized. Imagine a heavily indebted corporation as a massive, overflowing warehouse of toxic waste. The regulatory inspectors are coming to check the inventory. To pass the inspection, the corporation rents a secondary unmarked storage unit miles away. They quietly move all the toxic waste into this new unit, putting the lease under a different name. When the inspectors arrive at the main warehouse, it appears spotless and highly efficient. Over a period of years, Enron's financial architects established hundreds of these shadow companies, utilizing bizarre cryptic names like Chuco, LJM, and Raptor. Enron would officially transfer its failing assets and its massive debts into these shadow companies. Because the SPEs were legally separate, the toxic debt was wiped clean from Enron's public balance sheet. But here is the structural flaw, the fatal vulnerability. To convince external banks to lend money to these empty shadow companies, the debt had to be guaranteed by something of value. That collateral was Enron's own stock. This created a mechanism known in financial forensics as the death spiral. As long as Enron's stock price continued to rise, the shadow companies remained perfectly solvent and the debt remained hidden. But the entire architecture was built on a foundation of ice. If the temperature rose, if the stock price dipped even a few points, the collateral would instantly lose its value. The banks would demand immediate repayment, and the toxic debt would violently boomerang back onto Enron's main ledger. The executives had constructed a machine that required perpetual, impossible perfection. Illusions are fragile. They do not shatter from physical force, they shatter from curiosity. The disintegration of a $70 billion empire began not with a federal raid, but with a single, simple question. In early 2001, an investigative financial journalist named Bethany McLean published an article titled, "Is Enron Overpriced?" She pointed out a glaring anomaly in the public filings. Despite reporting massive, unbroken revenue growth, the company's cash flow was deeply negative. She asked the question no Wall Street analyst had dared to ask: how exactly does Enron make its money? The corporate response was aggressive evasion. During a live conference call with elite investors, the CEO openly insulted an analyst for simply requesting an updated balance sheet.
In the world of high finance, hostility in the face of basic accounting questions is the loudest alarm bell in existence. The timeline of collapse accelerated rapidly. By August 14, 2001, after only 6 months as CEO, Jeffrey Skilling abruptly resigned, citing vague personal reasons. In the markets, the architect abandoning a hyper-successful enterprise was the ultimate distress signal. The stock began to slide. The ice foundation was melting. Just 1 day later, on August 15, 2001, deep inside the accounting department, an executive named Sharon Watkins realized the catastrophic vulnerability of the SPE structures. She submitted a detailed, anonymous memo to the chairman, warning that she was incredibly nervous that we will implode in a wave of accounting scandals. The final fracture occurred on October 16, 2001, when gravity finally won. Enron was forced to announce its third quarter financial results, reporting a sudden, unexplained $618 million loss. Simultaneously, they announced a staggering $1.2 billion reduction in shareholder equity. The market went into shock. The shadow companies had breached the perimeter, and the hidden debt was spilling onto the main ledger. By October 22, 2001, the United States Securities and Exchange Commission announced a formal inquiry into the shadow companies. The reaction within Enron's auditing firm, Arthur Andersen, was immediate and systematic. In an unprecedented breach of protocol, orders were given to initiate mass document destruction. For days, teams worked around the clock, utilizing industrial shredders to destroy tens of thousands of pounds of audit papers and deleting countless gigabytes of internal emails. It was a desperate, clinical attempt to erase the digital and physical footprint of complicity. On October 24, 2001, the chief financial officer and architect of the shadow companies was officially terminated. The stock entered a terminal freefall, and Enron's credit rating was placed under review for a downgrade. In the energy trading markets, a credit downgrade means trading partners demand cash up front. The liquidity crunch became an absolute freeze. In a frantic final maneuver, Enron attempted to orchestrate a rapid merger with a smaller rival, Dynegy. But as Dynegy's forensic accountants opened Enron's actual books, the sheer scale of the toxicity was revealed. It was not just a bad quarter. The entire core of the company was hollow. The end arrived on November 28, 2001, when Dynegy terminated the merger agreement. Instantly, all major credit rating agencies downgraded Enron's debt to junk status, effectively locking the company out of the global financial system. Finally, on December 2, 2001, with all lifelines severed, reality asserted its absolute authority. Enron officially filed for Chapter 11 bankruptcy protection. The stock, which had traded at $90 mere months prior, closed the day at just 26 cents.
The forensic analysis of the Enron collapse yields a diagnosis that permanently altered the landscape of global finance. The executives faced severe consequences. The architects of the fraud received decades-long federal prison sentences for conspiracy, securities fraud, and insider trading, but the collateral damage extended far beyond the boardroom. Arthur Andersen, an 89-year-old institution and one of the big 5 accounting firms in the world, surrendered its licenses after being convicted of obstruction of justice. It was dissolved almost overnight, taking 28,000 external jobs with it. The ultimate cause of death for Enron was terminal hubris, facilitated by a total systemic failure of the financial immune system. The external auditors, the corporate lawyers, the Wall Street analysts, and the major investment banks, every single entity designed to act as a gatekeeper for the public, chose to suspend their skepticism. They looked at a business model that defied the laws of mathematics, and they applauded it simply because the advisory fees and the stock options were too lucrative to jeopardize. Enron stands as a permanent monument to the limits of engineered complexity. When a corporate financial model requires an advanced degree to decipher, it is rarely a sign of genius. It is almost always a mechanism designed to obscure the truth. You can fabricate your profits, you can bury your debt in the shadows, you can shred the evidence, but eventually the capital runs dry, and math always reclaims its balance. The markets never forget, but they do forgive the next fraud. Subscribe to Financial Autopsy to see who falls next.